The U.S. stock market is closed right now on this Wednesday, May 27, 2026, with the opening bell still hours away. Looking back at yesterday's historic regular trading session on Tuesday, May 26, 2026, Micron Technology Inc. closed at an absolute record high of $895.88 per share, marking a massive single-day surge of 19.29% and pushing the stock to an intraday peak of $916.80. This explosive move officially propelled the Idaho-based chipmaker past the $1 trillion market capitalization milestone for the first time in its 48-year history. While retail investors on various investing sites are celebrating this vertical liftoff, the reality beneath the surface reveals a far more complex and highly cyclical structural knot than the current euphoria suggests. The immediate expectation circulating across financial media is that memory chips have completely shed their historical legacy as cheap, volatile commodities. The narrative driving this massive premium is that the massive infrastructure build-out for data centers has permanently structurally altered the business model for high-bandwidth memory. Investors looking at the spectacular rise of the Nvidia stock are aggressively applying the exact same valuation multiples to Micron, convinced that the company faces a permanent state of undersupply and infinite pricing power. This expectation is exactly why a leading Wall Street analyst nearly tripled their price target on Micron yesterday to over $1,600 a share, sparking a classic institutional buying panic. However, the underlying reality that sophisticated practitioners of online investing must confront is that memory manufacturing remains an exceptionally capital-intensive, high-fixed-cost business that has historically been defined by punishing boom and bust cycles. While short-term supply constraints are undeniably real, the belief that this upcycle will never crest ignores the massive physical footprint expansion currently underway globally. When the supply of high-bandwidth memory inevitably catches up with the structural needs of corporate data centers, the pricing power can dissolve far faster than the market currently anticipates. This stark contrast between the current absolute optimism and the rigid reality of capital expenditures is where the real tension lies for individuals engaged in self-investing. The explosive momentum we witnessed in yesterday's trading volume, where over 74 million shares changed hands compared to a normal daily average of under 50 million, highlights a massive institutional repositioning. Huge asset managers, including heavyweights like Vanguard, BlackRock, and Fidelity investments, are aggressively reweighting their tech portfolios to ensure they are not left behind in the memory supply squeeze. This massive institutional volume was triggered by a dramatic structural upgrade from UBS, where analysts argued that the company could see accumulated free cash flow exceed $400 billion over the next few years. This specific projection has caused a massive wave of capital to flow through almost every online investment platform, pulling retail traders along in a frantic search for the ultimate artificial intelligence bottleneck. To put this weekly and monthly swing in absolute perspective, Micron stock has surged by more than 50% in the last 30 days alone, completely decoupling from standard semiconductor sector multiples. On popular individual brokerage apps like Robinhood, trading activity has spiked to near record levels, as retail participants pivot their focus away from traditional processing units towards hardware components. For anyone managing an individual brokerage account or looking for comprehensive investment help, this kind of vertical price action creates a massive psychological challenge. It forces you to balance the fear of missing out against the fundamental mathematical reality that the equity is now trading at a massive premium relative to its historical valuation metrics. We can see a highly coordinated sentiment shift across the entire tech complex, directly influencing how capital moves through automated systems like Schwab Intelligent Portfolios or a customized SoFi Invest strategy. When major Wall Street houses like Citigroup and Mizuho rapidly raise their targets to over $800, only to see the actual price immediately blow past those estimates within hours, it indicates that traditional valuation models are breaking down. This environment favors aggressive platforms like the Interactive Brokers Trading Desk, where institutional options volume and complex derivative hedging have heavily accelerated the upward delta squeeze. Every time the market senses a tiny bit of supply tightness, automated algorithms and high-frequency trading platforms systematically bid up the entire sector. I want to pause here for a moment and get your direct take on this historic valuation milestone. Comment below how many shares of Micron Technology you currently hold in your portfolio, and let me know if you are buying more at these all-time highs or taking profits. When you study the immediate daily movements, the critical catalyst that sustained yesterday's late afternoon rally was management's updated commentary from recent financial conferences, including updates provided to JP Morgan analysts. Executive leadership explicitly stated that their entire output for high-bandwidth memory is entirely sold out not just for the remainder of this year, but through the entirety of next year as well. This means corporate buyers are signing long-term fixed-price contracts to guarantee their physical allocations, a structural shift that provides the company with highly visible revenue streams that it has never enjoyed in previous product cycles. This specific detail has given operators using the SoFi trading platform or the Fidelity trading platform immense confidence that the near-term cash generation is completely secure. Yet, experienced market participants using tools like the Interactive Brokers platform know that total contract visibility does not completely eliminate execution risk. Building and scaling advanced semiconductor fabrication facilities requires flawless execution, and even minor yield issues on the newest memory architectures can instantly compress operating margins. Furthermore, the broader macroeconomic landscape is flashing intense warning signals, with long-term treasury yields hovering near multi-year highs and putting severe structural pressure on broader equity market valuations. If consumer spending cools or if enterprise tech budgets face sudden restrictions due to persistent inflationary pressures, the massive capital expenditure budgets allocated for advanced server infrastructure could face sudden revisions. To truly understand how Micron reached a trillion-dollar valuation, it is essential to look at the foundational architecture of the business and what the company actually does. Founded in Boise, Idaho back in 1978, the firm has spent decades navigating the hyper-competitive global landscape to emerge as the sole major American manufacturer of computer memory and data storage products. The company operations are structured across 4 core segments: the Compute and Networking Business Unit, the Mobile Business Unit, the Storage Business Unit, and the Embedded Business Unit. Through these divisions, they manufacture dynamic random access memory, standard flash memory, high bandwidth memory, and solid-state drives that power everything from consumer smartphones to massive military defense networks. For decades, the standard investment thesis for this company was entirely tied to the personal compute and mobile phone replacement cycles. When global demand for consumer electronics spiked, memory prices would soar, leading to massive short-term profitability that immediately triggered an oversupply wave as competitors expanded capacity. This commodity dynamic meant that platforms like Fidelity mutual funds or conservative wealth management accounts viewed the stock as a trading vehicle rather than a core long-term holding. The historic financial reports illustrate this structural volatility perfectly, showing massive swings in annual revenue and deep net losses during historical downturns when global chip inventories became severely bloated. The fundamental shift occurred when the structural demands of advanced computing completely altered how modern servers process information. Standard processing units require an immense amount of local data throughput to handle complex algorithmic computations, turning memory speed and physical bandwidth into the ultimate performance bottleneck. By developing specialized high-bandwidth memory architectures, the firm positioned itself as an essential hardware gatekeeper for the entire infrastructure ecosystem. This means that when a cloud provider purchases advanced accelerators from corporations like NVIDIA, they are fundamentally required to purchase corresponding amounts of ultra-high-speed memory to achieve optimal operational efficiency. This structural reality has completely altered the layout of modern investment portfolios, forcing both retail traders on the Robinhood app and professional managers handling Fidelity investments to reevaluate their asset allocations. In the past, automated systems like an intelligent portfolio might have heavily restricted exposure to cyclical hardware names due to their inherent price volatility. Today, however, the intense institutional demand for data storage solutions have turned these components into defensive infrastructure assets, heavily tracking the capital expenditure cycles of massive tech conglomerates. This massive influx of capital has transformed the everyday trading environment across major investing sites, driving unprecedented liquidity into the semiconductor complex. Looking ahead, the future outlook for the company will be entirely determined by how the tension between contract expectations and physical production reality resolves over the next 24 months. In a highly optimistic scenario, the structural demand for specialized server hardware remains completely unquenchable, allowing the firm to maintain its historical pricing power and execute its massive domestic expansions in Idaho and New York. This outcome would completely validate the aggressive long-term projections circulating across the Interactive Brokers account network, potentially turning the company into a permanent anchor of the global technology economy alongside traditional software giants. Conversely, the primary structural risk is that the current level of demand is heavily front-loaded due to corporate panic buying and defensive inventory hoarding. If major cloud hyperscalers realize they have over-provisioned their data center capacities, or if the commercial monetization of advanced software applications slows down, a sudden pause in component ordering could occur. Because the company is simultaneously investing tens of billions of dollars into building out new domestic fabrication facilities under the CHIPS and Science Act, a sudden drop in market pricing would hit the balance sheet at the exact moment capital expenditures are peaking. This specific risk profile is exactly why more conservative strategies within Fidelity Wealth Management are maintaining a close watch on global inventory levels. When you synthesize the entire situation, yesterday's historic closing price of $895.88 and the milestone trillion-dollar valuation represent a monumental triumph of corporate positioning, but it comes with a massive expectation hurdle. The market has completely priced in a flawless execution of the current product cycle, leaving almost no room for technical delays, global supply chain disruptions, or macroeconomic deceleration. For investors managing their portfolios via the Robinhood stock trading platform, SoFi Investing, or traditional individual brokerage accounts, the key to navigating this asset is looking past the daily emotional headlines and focusing strictly on contractual cash flow sustainability and global capacity additions. The expectation is a permanent structural shift. The reality is an incredibly well-positioned but inherently cyclical business operating at the absolute limit of its capacity. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, bell, subscribe for more updates.